Hello everyone, Dave Landry here from DaveLandry.com, and this is Trading Simplified, episode 27. Wow, time is flying by. So what do we talk about? Well, I want to continue with my 12 plus 1 trading rules, and this is part 2. We'll probably have one more part, because the elephant in the room, or the bear in the room, is obviously the overall market. So I want to continue on what I've been talking about lately about where will I become bullish? And then I also want to give you a bear market update. Speaking of updates, I want to do a quick update on the mystery chart, and then we'll get back to those rules. By the way, housekeeping. I do take requests. If there's something you want me to discuss, please let me know, and I will cover it in upcoming shows. Or I might be able to point you in the right direction for a more thorough answer on that. Yes, if you're looking to find me, DaveLandry.com. Again, if you would like the slides from this show, DaveLandry.com/StockCharts. I'll also give you the slides from the previous 26 shows, a free market timing course, all 3 of my books for free in PDF format, and a plethora of other things to keep you busy for a long, long time. You can reach me at DaveLandry.com/contact. Now, I'm just going to gloss over this quickly because this is something that I've said quite a bit. I want to show you where we are in the market now, but I would like this to become evergreen content, meaning that if we're looking at something like a setup, such as a bow tie or whatever, the next time this comes along, you have learned that setup. Just in case I get hit by a beer truck, or more likely, as I've been joking, my wife kills me while I'm in quarantine. You know, I'm made for this quarantine. It's funny. It's like, hey, it's just another day for me, and everybody else is freaking out a little bit. If anything appears to be, in hindsight, of pouring salt into wounds, I can assure you that I'm not. And what I would encourage you to do is go in and look at the bear market updates, and you can see how I saw these signals and signs as things began to unfold. And then, obviously, this is a very fluid situation. So if you go to my website, DaveLandry.com/bear-market-2020-updates, or just go to the home page and click on this link up here, you can get the latest bear market updates. Also, lately, just because it's been so crazy, the updates haven't made it to the page for a day or two, so check the home page first before going to look at those updates. And also, I would encourage you to look at those updates just so you can see, look at them in reversed chronological order. Is that correct? Go back in, chronological order, so you can see what I was talking about when I was talking about it. A few years back, I was watching a presentation from Linda Raskey, and she said that the market will do the most obvious thing in the most unobvious manner. And she went on to say that it will do what it has to do to frustrate the most or cause the most pain to the most amount of people. And I asked her about these adages, and she just said she probably picked them up on the floor and didn't even remember saying them. She's very modest. Anyway, it really drives the point home, or these adages really drive the point home in the current market. So if we look at the S&P 500, we obviously went into this huge slide in early March, and then the obvious thing for the market to do would be to keep on sliding, for that big blue arrow to keep on keeping on. But instead, what happened? Well, an unobvious thing. The market is the mother of all rallies, and in this rally, the bottom pickers were rewarded. The people who are bored at home and decide to start trading, long side only, of course, had this huge updraft behind them and made a lot of money and think this trading thing is easy. And of course, what will likely happen, at least from where I sit or stand, depending on the time of the day, is that the market will head back down towards its old lows. And if you think about those two adages, what would cause the most amount of pain and the most amount of people? Well, obviously, squeezing the shorts would cause a lot of pain. Sucking in the bottom fishes would cause a lot of pain. And also giving a little hope to the buy and hope crowd that this whole thing is over would also cause the most amount of pain. Remember, we're reading the psychology of the market. Now, this is actually just a small piece of a much bigger bear market update. I'd encourage you to go to my website and check that one out. It's from 4/20. Now, again, I think this market still has the potential to roll back over, but as I've been preaching for several weeks here, I will believe in what I see and not in what I believe. If I get stopped out, I get stopped out. Now, everybody's saying, Dave, exactly where will you become bullish? And as I've been saying quite a bit, like Justice Potter Stewart, I'll know it when I see it. But one signal that I'd pay attention to is the daily bow tie signals. And then, as I've been saying quite a bit, we had one on the 4th that triggered to the downside. And then now the moving averages are coming together once again. Now, with the bow tie, especially longer term, such as weekly charts, you like to see these coming off of all-time highs and major lows. In something like the energy stocks, we might see some bow ties, and that might be 3 or 4 or 5 or 6 months from now, but it could shape up really nicely with these energy stocks coming off of all-time lows, so we'll keep an eye on that. This is a 3-year low in the S&P. That's a decent low, but I'd like to see like a 10-year low or longer, and I'll talk about that in a few minutes in a little bit more detail. Now, as I've been saying quite a bit, these moving averages have been coming together. And as I said in prior weeks, when the price crosses above an exponential moving average, and if you look over here, here are the moving averages that I'm using for the bow ties, 10 simple, 20 exponential, 30 exponential. But as I've been saying quite a bit, as I've learned from Greg Morris, when price crosses above the exponential moving averages, the moving average, will turn up. Now, if price crosses back below the exponential moving averages, then the moving averages will turn back down. So this 2750 area would be an area to watch for the market to possibly make a bow tie to the upside. Now, once that happens, I don't know if I'm going to rush out and get all bullish, but it would certainly be a sign that I would have to pay some attention to. Now, as I said in prior weeks, keep an eye out for the weekly bow ties. Not every signal turns into the mother of all bull or bear markets, but as you can see from this chart, these major signals coming off of all-time highs and multi-year lows, such as 2009, which was the 13-year low, and 2003, which I think was a 5 or 6-year low, you did see some pretty serious runs from them. Now, as I've said quite a bit, 2015, you did have a bow tie to the downside, and although it looks like a little blip on the chart, that was a fairly ugly price movement, and even uglier was a slide that we saw in 2018. Go in and watch last week's presentation, and you'll see where I talked about the Russell 2000. And now we have another weekly bow tie to the downside. So based on this pattern, this setup, this could be the real deal. As Greg Morris often says, we treat every signal as if it will become the big one, and that's Elizabeth implied. So if we zoom in, you can see that these moving averages have come together and begun to spread out. They went from uptrend proper order, 10 greater than 20, greater than 30, to downtrend proper order, 10 less than 20, less than 30. Now, if all you did was pay attention to the order of these moving averages, and you could pick your favorite time frame or use multiple time frames. I have one client who does a lot of market timing off the hourly chart. Nothing wrong with that. You're just going to get more signals and possibly a little bit more whipsaw. But based on this weekly bow tie, we're now setting up for a bow tie to the downside, and a trigger would be around 2,700 below last week's low. So pay attention to this signal and pay careful attention to the 2,700 level. Now, again, this bow tie back in 2018 in late November, early December, even though that didn't turn into the mother of all tops, that slide back then was pretty big. And as I wrote in the last update, I kind of a man on the street kind of guy, and I met somebody when I was renting a truck, and he said that he's glad he held on through that slide and he wished he would have bought more. So this market and markets in general tend to be a really bad teacher. So we'll see how that unfolds, obviously. So check back often. Look at my website homepage, davelandry.com. Look at the bear market updates. And then, hey, you know what? You guys have charts here at StockCharts.com. Put the bow ties on there and pay attention for signals such as bow ties on your own charts. And as usual, take things one day at a time. Now, I am very setup driven. I look at a couple thousand stocks every day. One of my members in my Facebook group put a list of momentum stocks up this morning, and I agreed with all of them. They're not set up yet, but when they set up on the long side, I might take them if I really, really, really like the setup. But I know in the back of my head that I don't have a tailwind behind me because the market looks like it's trying to go back to its old lows. So I'm going to have to really, really, really like the setup to take it. Now let's do a quick mystery chart update. Last week and weeks prior, I showed some charts from the buy side setups or from the long side. And what I did just to gain perspective was I flipped these charts over. So they're actually shorts, but let's just take a look at this as GSX. It bottoms out nicely. I'm making little air quotes. And then the moving averages come together and begin to spread out, giving us a bow tie to the upside. Looks like the trend has turned. It's headed higher. We got the bow tie again, and we had a buy signal here. Now, we flipped the chart over. This was actually a sell short. This was in my trading service. You can see kind of inverted cup and handle looking, and a bow tie, obviously, again, to the downside. So it looks like the trend is done and a new trend is emerging. The trigger was at 30.50. So far, this hasn't worked out fantastic for us. Obviously, it's going against us a little bit, but it's turned back down today. And, we get stopped out, Let's just see how it works. By the way, take a look at these moving averages once again. Now, keep in mind this market was trending nicely. But as a general statement, if you stayed long or traded mostly the long side when the 10 was greater than 20, greater than 30, as a general statement, you would usually be on the right side of the market. It always amazes me how something so simple can actually work in real markets. And you could see when they started chopping around, the market was losing steam and it wasn't really giving you a signal. And then when they flip back over, it suggests that the trend may have ended. And by the way, we did cover bow ties in a prior presentation. I have plenty more information on that on my website too. All right, let's get back to these trading rules. Number 5 is know your methodology. Every methodology will have its sweet spot. Now, we talked about this last week, so let's just recap a little bit. And there's a few things I want to add to it too. As I said last week, the sun doesn't shine on the same dog's butt every day, meaning that certain market conditions work better for certain methodology. Now, we're trend followers, so just like you can't catch a tan when the sun isn't shining, you can't catch a trend when there is none. So trend following, like everything, works incredibly well until it doesn't. And as I showed in prior presentations, we did really well on the ride up. We lost some money on the way down, giving up some of those open profits and a few outright losses. Began to accumulate in the portfolio. But then we started printing money again, which was really cool after that March slide began to resume. And then, of course, we gave up some in the retrace. Now, adding to this slide, which I put together last week, we're making back some of that money once again. Now the market is rolling back over. But the sun doesn't shine on the same dog's butt every day. And you can't let these good times go to your head. You have to enjoy them by all means, but just know that they won't last. I've seen quite a few amazing things happen in my lifetime. One was a friend and a couple of them were with clients. And in these cases, I've urged these people to cash out, pay off the mortgage or buy a house, and have a free place to live because these times won't last. Unfortunately, in these cases, it went to their heads. And one guy, as I've said quite a bit, ended up at my doorstep homeless after about $1 million round trip. So very painful thing to see. Somebody recently asked me how long should they paper trade, and my answer is until you experience an upcycle, a down cycle, and a choppy sideways cycle. Now that could be a long, long time, obviously, but he's really young and he's got quite a few years ahead of him as a trader if he sticks with it. But what I would recommend you do is maybe just trade at a very small size until you understand what each cycle is like. I did have one client come in 2000, I believe, or it was probably 2007, 2008. And his first trade was taking a short trade that I recommended. First trade ever on the short side. And he grew to really, 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 really love the short side. Unfortunately, when the trend turned, it was really hard for him to begin buying stocks after he made so much money on the short side. Fighting the last war, so to speak, is a very common problem when you hit it really, really, really well. So you can't let those good times go to your head. Now, you're probably thinking, hey, Big Dave, are you holier than thou? No, hell no. Sometimes I have found myself fighting the last war. For instance, in 2000, I printed money coming into 2000 on all these momentum stocks. And when the market began to crack, I failed to recognize, at least initially, that conditions have changed. And I was still fighting that last war, so to speak. One example that I've given here quite a bit, I was in Italy, I think in 2008, or whenever the oil ran up to about 150 bucks a share, was allegedly going to go to 200. And I went to an awards ceremony, and they were giving awards out to all these fund managers. And most of the fund managers who had the best performance were energy funds. And I remember leaning over to John Bollinger and saying, we're not going to see these guys here next year. And that's because they happened to be at the right place at the right time. Not to take anything away from them, because what they did was amazing. But they were forced to buy energy stocks, and guess what? Energy stocks just went up several 100%, so they did incredibly well. Unfortunately, the crude oil crashed shortly thereafter. Now, I have gotten a little full of myself here and there during the uptrend. I found myself getting a little cocky, and I've got to be cognizant of that. And on the initial slide, when we started doing well then, I probably got a little full of myself, and then the retrace rally spanked me a little bit. One thing lately, I think I failed to fully recognize how much conditions have changed and how rapidly they changed. And the volatility is absolutely whack. Things that were working really, really well, such as these little opening gap reversal trades that I would do for S&Gs, pick up a little bit of money along the way, no longer were really working out. So the market will humble you quite a bit. If you see people out there bragging about how easy it is, you want to make sure you run, not walk away from them. All right, number 6, don't deal in mediocrity. Pick the best and leave the rest. And by the way, these rules were put out many years ago, and what I recently did by accident, I found them on the back of my website. And what you're seeing here, and if you go in and find the rules on my website, is an updated version of those rules. And basically, the rules are exactly the same, except I added a few things to them and threw in some random thoughts. Now, along the lines of dealing with mediocrity, acrasia comes to mind. Now, I've done complete presentations just on acrasia, and I think it's going to be really good fodder for an upcoming show. And I am guilty of acrasia as much as anyone, and I have to take steps to guard me from myself. So again, I'm not holier than thou. Now, acrasia, according to the Google Dictionary, is a state of mind in which someone acts against their better judgment through the weakness of will. Obviously, diet would be a good example there. You're like, oh, well, I'm just going to go ahead and eat this thing or drink this thing I'm not supposed to, even though it's not on my diet, because I'll diet later. And that involves a time inconsistency. The example given quite often in pretty much any one of these behavioral science books or behavioral psychology books is that if somebody offers you $500 today, or you can get $505 tomorrow, most people would opt for $500 today. But if the offer was $500 in 365 days or $505 in 366 days, most people would opt for the $505. Now, when you crunch all the math, you're looking at $5 in one day. But people see the short term much differently than the longer term. Now, this is just a little thumbnail of a much, much bigger presentation. And I would encourage you to go in and read the article on my website and then keep an eye out for a future presentation on this. We tend to steal from our future self, and I'm as guilty as anyone. And I am a position trader, and when I get into a trade, I hope to be in that position for a long, long time. Now, I'm slotted as a swing trader because I will take partial profits, but I'll also hold on for a long time. And go in and watch some of the older Trading Simplified shows, and you'll see that we put on positions many, many months ago, and we held them and held them and held them and held them. And then eventually, of course, you do get stopped out. Now, I am guilty of the occasional day trade where I steal from my future self, and I'm like, oh, I'm only going to lose $400 in a trade. I could just sweep that under the rug. Now, if you annualize that, that's about $100,000 a year, and take it one step further, if I'm doing that in multiple accounts, before you know it, it's $300,000 or $400,000 annualized a year in losses. So the point is, it begins to add up, and it's very easy to not get a little bit pregnant, so to speak, in doing these kind of things. Or I guess I should say, you can't get a little bit pregnant. It's a slippery slope. Now, my biggest question for the longest time is, why do successful people deal in mediocrity? I have the luxury, or the privilege, I should say, of working with very successful entrepreneurs, real estate moguls, doctors, lawyers, automatic transmission mechanics, people who are very successful in what they do, but they a lot of times will email me these crappy stocks and say, hey, what do you think about this? Or I just bought this. What do you think about it? And I just couldn't understand why these people who are successful in life deal with such mediocrity in markets. And again, this is a much bigger presentation than I've done before. But I did get my answer one day. Dr. J, who is a psychiatrist, explained to me that if you're a doctor, a lawyer, automatic transmission mechanic, you can't sit around and wait for that fat pitch, that perfect client to come along. You have to take whatever train wreck comes to you, even though you might have some sort of negative outcome from that. So you can't sit around and wait forever, because you would go broke, obviously. You have to, again, take whatever train wreck comes along. So the longer you are successful outside of trading, the more likely, from a psychological basis, you may be tempted to take a mediocre trade. Now, along the lines of taking mediocre trades, you really need to do nothing unless there is something to do. Now, let's do a little math here. So performance is equal to your good trades minus your bad trades. I know, duh. In my members area of my website, I have everybody set their goals, so when you log in, you're forced to look at your goals. And maybe I need to reread my goals a little bit more often too. And my goals, just real quick, is to take only the best opportunities, and when there's nothing to do, do nothing. There's that do nothing again. Once I do find an opportunity, I will carefully plan that trade and then follow the plan. I will resist the urge to micromanage, day trade, or take any unplanned trades, with the exception of a money lying in the corner, S&G, opening gap reversal type trade. So an opening gap reversal, I'm going to bet a small amount of money on something that's, I hate to use the word a sure thing, but a fairly sure thing, and look to catch that opening gap reversal. And that's just kind of like an S&G trade to make a little money. That's not where my bread and butter is. But as I just said a few minutes ago, I've got to be careful with my intuition versus intuition, which comes from market wizards, and I think Sakota said that first. In other words, trying to force something to happen. And that kind of circles back to the acrasia, through the weakness of my will, doing something that I'm not supposed to do. Now, the reason I brought up my trading goals is one of my clients who recently joined, as part of his trading goal, said to not lose capital. Well, you're going to have to put money into harm's way. The only way to make money trading is to put money, obviously, into harm's way. So you cannot avoid losing capital. That would be a holy grail. Remember, your performance is your good trades minus your bad trades, right? Well, your bad trades, you lose money on, okay? If you eliminated all your bad trades, then you would own the world. And unfortunately, that's not possible in spite of what these YouTube gurus claim to say. So you can't avoid losing capital, but you can not trade in less than ideal conditions. So if you're a trend follower and the market is going sideways, then maybe you should wait until you have the mother of all setups because the market is not behind you. And as I said earlier, we're in a downtrend, obviously, for now at least. And for me to get excited about buying long side setups, it's going to have to be a really, really, really good setup because I don't have that tailwind behind me. Now, along those lines, I say take the can't stand it test. If you couldn't live with yourself, if you didn't take the trade, okay, let's say you say, okay, I'm not going to take this trade, and you just have this feeling like, you know what, if I come in tomorrow and this thing is up big, I'm going to really, really hate myself. But a lot of times you're like, well, if it's up big, I don't care. It's not a great setup. When you get to that point, that's when you've reached the true enlightenment. Now, as I've said before, when I wait and I wait and I wait, I nearly always make money, especially with something like these opening gap reversal trades, these S&G trades. But if I wait and wait and wait, if I wait 3 weeks for a one-day trade, usually I always make money. And if I don't feel bad about it because I know I did the best thing. And the same thing goes for the position trading. A lot of times, for people who just sign in the service and like, this guy doesn't ever do anything, a lot of days recently I'm like, nope, there's nothing to do, so we need to sit on our hands and wait for the next big opportunity. Now, one thing you can do, and it sounds a little bizarre, but time travel into the future. And if you stop out in your mind's eye on this trade, would you be really upset or shrug your shoulders because it was worth a shot? And there was a book called Mind Sculpting by Ian Robertson, so you might want to check that out. And believe me, it's like I came in today and I had a big loss overnight on a trade that I should not have held overnight. Had I said, you know what, Dave, let me see how I'm going to feel if I take this trade and I come in tomorrow and it's halved in value, how would I feel about that on this day trade that I shouldn't have held? So I don't want to come across again as holier than thou. I do make a lot of these mistakes. And I think that's why, from a psychological perspective, I'm able to discuss these things, quite frankly, with you. Okay, looks like my time is up for today. So next week we're going to pick up on these trading rules, and I'm going to do a little bit deeper dive into trading psychology, and then hopefully be able to pull it all together to help you follow these trading rules. If you need follow-up information, again, davelandry.com/StockCharts, and I'll send you a bunch of stuff to keep you busy for a long time, and hopefully eventually you become a member of the website and you can interact with other traders, including myself. And if you do need to reach me, davelandry.com, easy for me to say, /contact. Okay. Everybody stay safe, stay sane. Thanks for watching, and may the trend be with you.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.